Good afternoon and welcome to our FBF online seminar. My name is Pierre Schlosser. I'm the scientific coordinator of the Florence School of Banking and Finance, and it's a real pleasure for me to welcome you all to today's online seminar on the anti-money laundering architecture. I'm very glad to welcome our lead speaker of today, Professor Peter Alldridge, who is Professor of Law at Queen Mary University of London. Peter, thank you very much for being with us today. I will not introduce you to the crowd today, but note that this biography is available on our website. I think that it's fair to say that for a very long time, and one could argue even until end 2017, anti-money laundering was considered to be a non-issue. It was more seen as a sort of set of standard processes that the industry needed to comply with. It was certainly not a policy issue, and it was even less considered to be a potentially relevant area for banking prudential supervisors. Well, as you can see, and as we can see, things have changed, and otherwise you could argue we wouldn't be here today to discuss the growth of the AML architecture, both with Professor Alldridge and with Nikita Divissenko from the European University Institute, and which I'd like to welcome. As always, let me also thank my colleague Jan for the preparation of the seminar. Well, before entering into the fascinating discussion that we have planned for today, I'd like to inform you about our school's upcoming activities in just a few minutes. As several of you already know, a key line of activity of our school are our residential training courses, and you will see on the slide who typically attends them. You will notice that since the school's creation in January 2016, we have trained more than 2,500 participants coming from 75 countries. You can find more details, of course, on all our activities on our website, but let me just flag 3 courses which could be of interest to you. In late February, we'll host our Anti-Money Laundering Academy together with our partner Oliver Wyman. It is the 2nd edition of this course. We had really great exchanges last year, so we can't wait to have the course again. Also in February, we'll hold a course on bank recovery and resolution, which will include one academic, but also several practitioners, including from the European Central Bank, from BaFin, and from the Single Resolution Board. In April, we'll have the 3rd edition of a course led by Mitu Gulati, who is a professor at Duke University. The course is going to be on managing and understanding sovereign risks, and will also be co-taught by Lee Buchheit and Ugo Panizza. Having said that, we have plenty of other courses in the pipeline, so I just invite you to have a look at our website and at our LinkedIn page for more information. So I wouldn't drag this long. I would just now present you to one another to tell you that you're around 60 participants connected today. You're following us from several European countries and some continents, so there are 30 nationalities represented today. We are very glad to count on several participants from the public and the private sector. We have 53% of you who are women, 47% who are men. You have on average 8.5 years of professional experience. And this time we have almost the same share of economists and lawyers, but we also luckily have other profiles in the room, and that's great. So in terms of degrees, lastly, 79% of you have a master's degree, while 16% of you have a Ph.D. and 5% have a bachelor degree. So it is time we start. So how will we organize the seminar? Well, we've asked Peter to speak for about 20-25 minutes, and then following his presentation, Nikita will step in and share his comments with us for about 10 minutes. And after that, as the tradition wants it, we'll open up the Q&A session where you will have a chance to write questions, comments in the chat box. And then we'll take them sequentially in the Q&A session. So I'll stop here. I can see that Peter, you're already connected on the platform, which is great. I see that your mic is also on, so that should be all set up. So the floor is yours. Thanks again for doing this with us.
Many thanks indeed, and really 4 things by way of introduction. One is thanks for the invitation. The second is that I have reduced mobility. I walk with crutches, and so I very much welcome the use of this kind of interface to exchange ideas between academics. But it's the first time I've used this software, so I might mess it up. The third, by way of introduction, is that, of course, all academics in the UK in every subject are now saying in what respect their subject is and is not like Brexit, and I'm afraid I'm going to do that. The fourth is that thinking about you in Florence, those of you who are in Florence, and me in London, I was thinking about Michelino's painting on the wall of the Duomo of Dante and his Commedia, showing Dante next to the gates of hell with the notice on the above the gate, "Abandon all hope, ye who enter here." Voi cantrate. This is Blake's interpretation of that scene, and part of what I'm going to speak about is exactly at what point we crossed a point of no return. Now, you're going to be doing a lot of work on anti-money laundering. I've been thinking about money laundering and its relationship to the anti-money laundering architecture we have now, and how the history of money laundering came to be as it is. You can think of it if you wish, you don't have to, in terms of schools of historical explanation. Is it about particular individuals? Is it about social and economic forces? Or do some things just happen? And I think you might begin to see the links with Brexit there. Concern with money laundering begins with the war on drugs. There was a period in the early 1970s when drug regulation worldwide might have gone one or two ways, and it went the way of vigorous crime control. The war was declared by Nixon in 1971. As might have been foreseen, the consequence was raised revenue for drug dealers, a certain amount of anger and envy directed, particularly concern for the rule of law. There were questions about people emerging from prison to enjoy the profits of their crimes. The responses in various jurisdictions were attempts to seize the property of dealers. In the UK, this was done in 1986, and there was international implementation as a consequence of the Vienna Convention, and the entirely predictable results of all that activity were higher drug prices, greater profits available to drug dealers, no regulation, of course, of the quality of drugs available. The waterfront property was bought up by people with dark glasses, BMWs, and gold jewelry, who got richer and richer, and there was more anger and more envy and more concern for the rule of law. That's to say, the entire episode, at least by 2000, probably before then, had been regarded as pretty much a failure. Now, there are two ways in which you can respond as policymakers to failure. One is you can say, well, this isn't working, it was a bad idea, we need to pursue a different approach, back to square one. And at that point, shall we say in the year 2000, that would have involved reform of the drug laws, but it would also have involved reform of the laundering laws, because we would have asked whether we actually needed a crime of money laundering if, since it is drug dealing that leads to us being concerned with drug dealing, being concerned with money laundering. If we abolish the crime of drug dealing, might we have needed to abolish the crime of money laundering? Or you might say, well, the approach we're making, that's to say to seize property in the hands of criminals if it's the proceeds of crime, is a good idea in principle, but it's not working. And it's not working because the net isn't cast sufficiently wide, or the powers granted to law enforcement are insufficiently extensive, or because the outcomes are insufficiently punitive. We're just not doing enough. And if only we had that further thing, then it would all be good. And of course we went the second way, and that's what gave rise to the anti-money laundering industry. Something in the growth of ML and AML that hasn't been given enough attention, in my opinion, is the question exactly what is wrong with laundering. I think we should give more attention to the question whether and to what extent laundering is bad, and we need to consider various alternatives. The first, and this was the governing line, certainly in English law, certainly, again, up until 2000, 2005, something like that, is that laundering is bad because it is a form of complicity in the predicate offence. So if the predicate offence is drug dealing, then laundering is a form of complicity in that. And that you should deal with launderers as having committed that sort of crime, as being participants in drug dealing. And as soon as laundering extends to other offences, you should deal with them as participants in other offences. Or you could say that laundering is supposed to have some sort of deleterious effect on the financial system as a whole. And this is one that I think those of you who are bankers will have encountered. Or something else, that there is that bad thing about laundering which is somehow independent of the predicate offences, and we don't really know what that might be. Now, as you do know, the FATF has enforced its views worldwide, and it was established to set standards and promote effective implementation of legal, regulatory and operational measures for combating money laundering, terrorist financing and other related threats to the integrity of the international financial system. It is still less than transparent itself. It's sometimes difficult to find out exactly how it was that FATF decided anything. We do now have the so-called Chairman Summaries. There has been some work done to make the decision-making process more transparent. But that's what they're about. They're about the integrity of the international financial system. And so it is that the EU, in its successive money laundering directives, states that misuse of the financial system to channel illicit or even lawful money into terrorist purposes. So it's illicit money, that's the proceeds of drug dealing or whatever crime, or even lawful money into terrorist purposes because the terrorist program was established irrespective of the provenance of the money, poses a clear risk to the integrity, proper functioning, reputation and stability of the financial system. And this is the line that's repeated over and over again. To which I think there is a fairly short answer, which is that before 1985, when first people started to become concerned about money laundering, no bank ever failed because it was laundering money, laundering the proceeds of crime. Banks failed for all sorts of other reasons, but not because of that. And the history of banking in various jurisdictions attests to that. Banks may fail now because they launder money, but they fail now because they launder money in an atmosphere in which money laundering is regulated, in which there are controls, in which they will be violating. But take away the controls, then money laundering is not really that significant a risk to the financial system. And that's important because all the AML regulation is based on that idea. If you do think that AML is the way to go, then it is the logic, the internal logic of the system that you will expand and expand and expand. You will have to have an AML system geographically that covers the whole world, because if there is that individual jurisdiction in which it's possible to launder, then it will attract all the money. You have to expand by markets regulated, so you have to cover fine art if a lot of money is passing through fine art. I recently read a book about antique maps and so on, and gems, and you have to cover those, and insurance, and so there will not be any significant market that you don't have to regulate, again for the same reason, because if there is, then the logic is that all the money will go there. And you need to regulate professions, because you're pressing professions into service to act as informers, and you couldn't have a system in which one profession was forced to inform and not others, and you can't really have a system in which one has privileges and others don't, which is why we have arguments about legal professional privilege. You will get outsourcing of policing, and one of the reasons that people have been so keen to introduce anti-money laundering programs operated by banks and accountants and lawyers is that they think it comes for free, and of course it doesn't. And as a consequence of lack of clarity, as it seems to me, as to what was wrong with money laundering, we've created a huge, largely uncosted compliance industry, and it's very difficult to see how the size of the industry can be reduced otherwise than at the edges by using techniques like the risk-based approach and that sort of thing. The third significant alteration in money laundering that's taken place in this very brief history I've given you is the extension of laundering and AML to the proceeds of tax evasion. Again, until about 2000 or 2005, they didn't care about laundering the proceeds of tax evasion. The regulators, the FATF, the EU, local FIUs didn't care. And then there was quite a subtle change, and the FATF changed its advice, and all of a sudden tax evasion was included. There are difficult analytical questions. Is the tax still owed if you pay an order as a consequence of a conviction? What exactly has the evader gained if they still owe the tax to the government? How do we quantify, how do we identify the proceeds of crime when the crime is tax evasion? But you can see, if tax evasion is a crime, why should it be treated differently from other crimes? Well, some reasons might be these, that practically tax enforcers have great powers to collect money and consequently have alternatives to prosecution. It may be that the revenue raising agency has collection of tax as a higher priority than prosecution or non-conviction based approaches. I don't know, elsewhere in the UK there are only about 700 prosecutions for tax evasion in a year in the country. And of course it's easy for the tax man to win because the burden of proof favours the tax inspector in a way that it does not typically any other prosecutor. The consequences of extending the AML regime to tax evasion are that individual confiscation orders are easier to obtain. If somebody is charged with tax evasion and another offence, all the prosecution need do is prove the tax evasion, and that's relatively easy. There are obviously dangers of multiple counting, and I haven't mentioned any of the numbers. Essentially, if you look into claims for the amounts of money laundered in London or the UK or the world in a given year, you will find very large numbers, and some of them are difficult to follow. The data are at least very dubious. But if you include tax evasion, of course, you'll increase the sums laundered per sector, per jurisdiction, or worldwide. You'll make the problem bigger, you'll attract more resources to tackling the problem, and so on. One crime, incidentally, which hasn't really been addressed by AML yet, but might as a consequence of Panama Papers and Paradise Papers and so on, is, of course, violation of currency controls. Most of the money in the Panama Papers is where it is in violation of local currency controls. And if we start to say that violation of currency controls is if criminal were originally committed, so as to count for the purpose of the quantum of money laundered worldwide, then again it will go up. We don't really know what the metrics of success would be so far as concerns the extension to taxation. We don't really know whether more tax would be paid. We don't really have any very good way of monitoring taxpayer compliance, but it's being done and the consequences are as I have described. So we're in this position where we have now established the anti-money laundering industry with this interesting architecture, and I mean it's become so important for us now that even the Schumann Center is running courses on it. My claim historically is that, like Brexit, we just wandered into this position. At no point was there a fully articulated idea of what the wrong in laundering was, and in particular, why that wrong justified the imposition of the criminal sanction. We didn't really have a fully articulated idea of what the war on drugs involved, or any kind of exit strategy. You know, usually if you go into a war, you think, well, how's this going to end? And the war on drugs really didn't. We didn't really consider fully enough what the significance was when money laundering moved beyond drugs, and we certainly didn't consider what change would happen when we moved into tax. So I think I want to suggest to you that if possible, these things need to be reappraised, but it might be that we have got past, if you like, Dante's gate, and there is nothing in future much that can be done about the architecture of money laundering, except that it will become more and more rigorous. And the question is whether or not it will succeed. A few things just to finish. What I'm not saying is that global movements of capital are not important. They are important, and they can be damaging, and we need to do something about them. I'm not sure that the AML architecture we have is the best way to do anything about that. Likewise, some people want to argue that we need anti-money laundering because of the empty pizzeria argument, the ideal drugs, and then I launder the money through my pizzeria or my nail parlor or whatever it is, and nobody's ever seen in that, and it puts out of business the legitimate operation down the road. Correct. That, it seems to me, is a matter of competition law and not for, or not necessarily for, anti-money laundering. But I do think that of the options for responding to failure, the more likely option that will continue to be taken in money laundering is to increase powers and place greater obligations upon businesses. And we should always remember that the logic of the arguments about money laundering are that if there is one place in the world in which it is possible to own property, capital, money in a bank, whatever, in such a way that it is impossible to identify the true beneficial owner, then that place will attract all the money. And we are a long, long way from eliminating the possibility that such a place exists. One of the exercises I set my students is to try to open an anonymous bank account and to try to establish an anonymous company, anonymously owned company. This is an exercise started by Jason Sharman, who's now at Cambridge. It's still extremely easy to do it. So, if you like, that's my skeptical corrective to the advocates of anti-money laundering law. I will stop there.
Thanks a lot, Peter. So I think you really nicely flagged out the implications and the ramifications of AML and money laundering with drugs, with the taxing system, and I think that there is a lot to pick up on during the Q&A. But before the Q&A, I'd like to invite Nikita on the platform. So your slides are now up, and I just invite you to connect also your camera. So you're there, we can see you. Can we do a quick mic test, Nikita?
Yeah, sure. Can you hear me?
Yep. Okay, that's great. Okay, the floor is yours. You have about 10 minutes.
Thank you. Thank you. Good afternoon, everybody. Thank you, Professor Alldridge, for a very insightful and moderately skeptical presentation. I would like to pick up on one of the last points you made on AML looking for new markets, and briefly elaborate on this continuous expansion, on the logic behind the AML framework based on continuous expansion and on the enlargement of the net of its coverage. And I would like to do it in the context of financial sector regulation and the effect AML has on markets in financial services and law. In particular, dealing where the financial regulation is dealing with financial and payment innovation. I would like to begin by asking you a question. Jan, a poll should appear now. Yes, here it is. What do you think? Which areas of law, if any, have been affected by the development and ongoing expansion of the AML framework the most? For non-lawyers following us today, you can also think in terms of business operation practices, which are often shaped or affected by different branches of law and legal practice. So we have already talked about criminal and tax law, but what about financial regulation, or perhaps even competition or antitrust law, or even contract law? Or perhaps you would rather suggest that none of the above are in fact affected or in any way shaped by the expansion of the AML framework. So here's the question. I think you have about a minute to reply. And so now, in addition to the criminal and tax law matters already discussed, what I would like to comment upon and invite you to think about with me are the ways in which AML challenges and in a way affects the boundaries of other areas of law, such as regulation of the provision of financial services. And I believe that retail or transaction banking can suit as a good or perhaps the main example here. No, I don't have. How do I switch slides? Right, thank you. I depict these mutual effects as a triangle where AML framework affects business practices and vice versa. So AML expansion to a certain degree, of course, is triggered by changing business realities, so emergence of new risks due to novel to financial or technological innovation, for instance. On the other side, we have the AML framework affecting sector-specific regulation, such as financial regulation. And in addition, there is an interrelation between changing business and business practices, business operations and regulation. And this too is a two-way street. Now we can already see some preliminary results. Let's just wait for the poll to close. But it seems that, yeah, according to you, financial law and regulation have been affected the most by the expansion of the AML framework. So this is what I will focus on, and as we all would agree, AML framework today affects business models of numerous actors. In retail banking, credit institutions have been traditionally assuming the role of gatekeepers, and this gatekeeping has been primarily related to the deposit-taking activities, but also the operation of payment systems, of value transfer systems, which are crucial to the proper functioning of our economy. And today, this is largely motivated by the systemic risks and security considerations. Nowadays, with the increasing complexity and tendency towards modularity in retail banking and this importance of the gatekeeping role with respect to access to payment systems has significantly increased. Why? Because more and more players, the so-called non-banking service providers, offer a variety of services to consumers, whereas the provision of these services is dependent upon the access to payment infrastructure. In the context of AML, the main examples are money transfer services, such as online or mobile app-based payment or remittance services, and more recently also the virtual asset service providers, as they have been defined by the FATF. So, and despite the emergence of digital money, by that I mean e-money as well as virtual currencies, the services remain plugged into traditional banking. And with the growing of this need to provide a variety of factors to gain access to payment infrastructure, the gatekeeping role of the banks has been re-emphasized. I see a number of challenges here, both from business and regulatory perspective, which relate to the existing AML framework. Now, first, for can I have this slide back, please? Thank you. So first, from the business operations perspective, and this is a very simplified picture here, I have in mind the de-risking strategies, which are not novel, of course, banks having to modify and simplify their business models to comply with regulatory requirements. This is currently observed in the area of retail payments, whereby in a number of jurisdictions, certain non-banking payment service providers and also virtual asset service providers have been precluded from opening bank accounts and thus gaining indirect access to payment infrastructure due to policies adopted by banks. And these policies, they are, as a rule, they are based on indications from the supervisory authorities. And from the business or operational perspective, this affects, from the incumbent viewpoint, the revenue streams, and it also sets restrictions on onboarding certain types of clients, so the de-risking. On the other hand, from the newcomer perspective, this means restrictions on the benefits from the economies of scale. And it also raises entry barriers, significant entry barriers, or often it even precludes the access to the market all in all. Now, turning to the regulation, the next slide, please. Turning to the regulation, the way AML rules influence business behavior, so the left side of the triangle that we've seen, has a number of important consequences from a regulatory and legal standpoint. And I would like to underline three such considerations. So first, the gatekeeping. Today's regulatory regimes, such as the ones in finance, are based on authorization regimes whereby the entry to the market is subject to possession of an authorization issued by a competent authority to run a certain type of business activities. This automatically brings authorized entities under the supervision of competent authorities and within the scope of respective regulatory frameworks. And in the financial sector, an authorized entity generally falls under the AML framework. So they have to comply with the AML requirements. All authorized institutions such as credit institutions, payment service providers, e-money issuers, but also investment funds, and other financial service providers are obliged to comply with the AML requirements. What this means in the context of continuously changing AML rules is that to ensure compliance with these rules, the regulators tend to extend the scope of these authorization regimes. And to give you an example from my home jurisdiction, from Estonia, the authorization requirements have been introduced in 2017. The authorization requirements have been introduced for virtual wallet and virtual currency exchange service providers. So what happened? The notion of financial service provider, which is part of the financial regulation, has been expanded to include these new service providers, who then had to, or still have to, obtain an activity license and authorization from the Financial Intelligence Unit. Now these service providers are also included under the fifth money laundering directive, anti-money laundering directive. And what Estonian experience showed is that within less than 2 years, more than 2,000 authorizations have been granted. And to understand what this means in the context of Estonian jurisdiction, only about a dozen, 11 or 12 payment service provider authorization are currently issued in Estonia. So a dozen of payment service providers against more than 2,000 authorization is a big change. And as a result, hardly any actual supervision has been exercised by the competent authorities. On the one hand, due to the lack of resources, of course, but on the other hand, also due to the lack of absence of an actual physical presence of the supervised entities of the service providers in Estonia. And therefore, the point I'm making here is that the current approach of ever-expanding regulatory framework, including more and more activities and hence service providers subject to authorization regimes, is, amongst other things, clearly a manifestation of the growing influence of the AML requirements. And with the ever-expanding retail financial sector, including payment sector, the question is whether such an approach is justified, and if so, what is required for its effective implementation. And going back to Professor Alldridge's presentation, so once again here, similarly to the AML framework, we are constantly concerned with the fact of whether the coverage is wide enough, and well, the question is whether we can ever have a net which is wide enough. Now, the second point I would like to outline is the impact on the flexibility of regulation, which is important in particular in the context of innovative financial services. And here, what we can observe is there are mutual effects between the extent of the AML framework and the use of the flexible regulatory approaches with instances of self-regulation. And the problem that we can see here are the effects on competition within the markets and on the level playing field amongst market participants. So in the absence of regulations, of specific regulation for certain entities, and examples here could be, in addition to the virtual asset service providers, also crowdfunding or crowdlending platforms, which are often, depending on their business model, often considered as mere intermediaries and not regulated as financial service providers. So in the absence of regulation of such entities, they may nevertheless comply with the AML rules by introducing KYC and other procedures into their operations. However, in the current environment, such settings, so taking into account the gatekeeping role of certain of the incumbent market players, such setting often raises questions of level playing field, as different actors face different regulatory costs and administrative burden. And this consequently may result in implications for the function of the markets, and hence again raise the question of whether and how the regulatory frameworks have to be adjusted here. And my final point is on the implications on legal certainty. And this refers to the regulation of innovative products and services. The so-called wait-and-see approach is certainly valid, and it has been widely used. Yet it seems to, in the context of the AML framework, it seems to complicate things for a number of players by creating a certain degree of legal uncertainty. Examples from the financial sector are once again crowdfunding, where still no regulation at the EU level, and virtual asset service providers. And especially with respect to the latter in particular, what we have observed has been the influence of the opinions issued by the European supervisory authorities, which have been very influential, as they have been picked up by the national competent authorities, leading again to influencing the business practices, including de-risking that I have been talking about. So while the rationale from the regulatory and innovation perspective is clear here, the regulators desire to avoid over-regulation of innovative products and services in the markets which are not mature yet, and therefore to avoid hampering innovation by, for example, prompting the locking of certain technologies. What we see, however, is that the expanding and ever-demanding AML frameworks appear to put a certain pressure on the strategies due to the resulting legal uncertainty. So, if on the one hand, unregulated service providers do not have to yet are expected to comply with the AML rules, so where relevant, introduce customer identification and KYC procedures. On the other hand, regulated players such as credit institutions are already required and face a heavy regulatory and administrative burden to ensure that they themselves, but also their consumers, comply with the requirements stemming from the AML framework. So to sum up, what we can observe are a number of challenges related to the expanding AML framework, or as Professor Alldridge put it, the ever-expanding logic behind the the AML framework. And these challenges concern the strategies, the regulatory strategies that are used. And here we can observe a tendency towards also a similar ever-expanding logic behind the regulatory frameworks, such as financial regulation. And secondly, the expanding nature of the AML framework creates challenges for the effectiveness of the regulatory framework. So more seems to be required from the regulation and also from the supervisory practices. And this is, of course, not to. I adopt a slightly skeptical tone, but this is not to underestimate the importance and the weight of the AML risks for the financial sector. But certainly there are a number of questions that the regulators are facing and that we have to deal with. And I would like to conclude by asking you one more question, and this way we proceed to the Q&A session. And the question is, which, according to you, is the main regulatory challenge prompted by the expansion of the AML framework in the financial sector? Since we already switched to the financial sector. So ensuring legal certainty, maintaining level playing field, the increase of regulatory costs, supervisory effectiveness of the sound supervision, or perhaps ensure fair competition amongst market participants. Thank you. That would be all from my side.
Thanks a lot, Nikita. So I think you raised a few points that I'd like to give a chance to Peter to respond to before we open the Q&A. But that doesn't mean that as a participant you shouldn't start thinking or even writing your questions in the chat box. On the contrary, you should feel free to do that, since I know that there is a lot of questions that will come up. Peter, in a few minutes, if you could just engage with a few of the points that Nikita raised, and then we'll have a Q&A session based on the contributions in the chat box.
Well, I shan't spend all that long on this because I don't know very much about it. What I would be interested to press Nikita on, and many thanks for that intervention, is the behavior of the regulated sector when it comes to be regulated. Typically, as I understand it, at the outset, they object. They kick and scream and they say, this is going to be terrible for us. And it generally means that it's going to cost them a lot of money. And then, after a little while, they begin to buy into the whole exercise. This was certainly what was done, for example, in banks in the UK. They objected very strongly at the outset, and then they managed, first of all, to recruit the relevant people, and originally the recruits were, as you would expect, former police officers, and then people started to make careers in compliance, and as they made careers in compliance, they were able to say to their own bank, here's a risk, here's something you need to do something about. And they came to be accepted, and the organizations, I guess, passed the costs on to their customers, and so they worried about them less, but became less concerned about the costs. And I wonder if Nikita could say something more about that process, which interests me a lot, actually. Whether the UK is specific, whether
if you don't mind, I would suggest to park the question
and
so that we collect a few, because I can see there is a question from Jean-Christophe already, who is saying, are there estimates on the average AML budget invested in large EU banks and comparisons with the results of such actions? So basically he's looking whether there is a metric that could be elaborated on effectiveness simply in terms of resort.
They will tell you how much they spend. I don't think there are any metrics on their results. They might say how many reports they've made, you know, how many suspicious activity reports they've made, but beyond that, it would be very difficult to come up with an effective metric. I suppose you could then ask how many of those reports were then acted upon, and those data will be available. But beyond that, we don't really know.
And I think they might answer that they use a lot of automated processes. There is a bit of discussion also on using artificial intelligence for AML, as far as I understood. So I think that that's coming up, right?
Yeah. Yeah.
Okay. So why don't we also discuss the results that Jan has provided on the Q&A platform of the two polls which we've run. So one was about the main regulatory challenge prompted by the expansion of the AML framework. So I think the expansion of AML was really a key topic today. Would you like Peter to comment it, or Nikita?
Just a brief comment. I wasn't sure about the categories. It seems to me that level playing field and fair competition are pretty much the same thing, aren't they?
Well, the level playing field concerns more the interaction between the market players. So, in case of banking versus non-banking payment service providers, it is about the distribution of the fair distribution or the proportionate distribution of the regulatory burden and or administrative burden resulting from the regulatory requirements proportionate to the risks that arise from the respective activities of the different entities, whereas fair competition more relates to the interaction between these entities in what perhaps for example the access to the market is concerned in the situation once again where the banks are playing the role of the gatekeepers here. So this is that would be the distinction. And I would.
And what's your view on? Did the results surprise you, or did you expect that sort of distribution?
That I personally, I once had to I gave a talk about the impact on competition law, and in my opinion, yes, this impact is actually on competition law and actually competition concerns is minimal here. And it is more, well, maintaining level playing field has not been the most popular choice, but the regulatory cost and supervisory effectiveness, yes, that's definitely, especially when I'm thinking about the example I gave from the Estonian jurisdiction. It has definitely affected a lot the effectiveness of the supervisory practices, and then a lot has to be done there to accommodate the changes in the prompted by the expansion of the AML framework.
Okay, thanks. So I see that a few participants are typing. Perhaps Jan, we could share the results of the first question, which was more on the areas of law or regulation which have been affected by the AML framework. Thanks. And there we can see that respondents I mean, there is a bias in the selection. You can argue because we have a lot of banking and financial experts, but financial law and regulation came on top, followed by tax law and then criminal law. Would you like to comment these results, both of you, and then we'll take up the question of Michael Huertas.
Well, I don't know. Perhaps Peter, you would like to comment on the effects on criminal and tax law, because I would imagine that these have been affected so way more than follows from this poll. I would say it is comparable to the effects on financial regulation.
Yeah, I mean, it's a very small sample. The only thing I would say is that one of the tricks that AML has managed to pull off is convincing people that it has nothing to do with criminal law.
I agree, yes. And once again, here, competition law has, does not seem to have been affected. Contract law, well, I perhaps cannot comment on this at the moment, but I would imagine that there can be, if we look perhaps into certain types of contracts. Well, it's not contract law. Maybe the question was a bit too general, but if we look in certain types of contracts, then I would say that the AML regulation has definitely had a very strong footprint on this. For instance, yes.
You mean procurement stuff?
There is a point by Evangelos immediately on this, saying, I would like to point out that contract law has also been profoundly affected. AML controls and registration requirements when acquiring, for example, real estate. And he stresses that the voting buttons didn't allowed only for one, and indeed it wasn't multiple choice.
Right. Yeah. The domination of financial and regulation, which well coincided with the topic of my commentary, but perhaps did not quite reflect the opinion.
Then there is a comment by Michael. I think is more answering the question that Jean-Christophe had asked about data, and he shares some views on this. Would you like to pick that up? Otherwise, we will get a lot of other questions, as I can see people typing. So something that strikes me, Peter, you were mentioning the intrinsic link between the money laundering and AML and the fight on drugs, and emphasizes also the ramification, as I mentioned earlier, with the tax enforcement regimes, etc. So we're a lot now actually in a phase where basically there have been successive layers, and we've designed a system and a framework that needs to be enforced based on on past events and past conditions. Now, if you had a chance actually to travel back in time, and if you would be on let's say the day one of AML, where would you start? I mean, which authorities would you empower also? Because it looks to me that there are different types and natures of authorities involved in the fight against money laundering in Europe and elsewhere. I think sometimes the police is taking care of it, sometimes it's the customs, sometimes it might be even the tax authorities or the finance ministries. So what, it's not a steady, it's not an equilibrium, and it's not perfect, but if you had to do it again, where would you start and what would you do?
If I had to do it again, I wouldn't do it. I wouldn't create a crime of money laundering. And instead of that, I would spend the money that is being spent on compliance on other forms of law enforcement. And some of those forms of law enforcement might not be very popular because, of course, dealing with money laundering implies somebody commits a crime and then you've got the proceeds of the crime and the state is trying to seize those proceeds and try to stop people dealing with the proceeds. My question has always been, given that what they did in the first place is a crime, and given that the state criminalizing it didn't stop them doing it, why might we imagine that dealing with money laundering is going to have that much effect? It will have a marginal effect on, some, say, drug dealers might be deterred from committing an offence, but on the whole, they won't be. So instead of that, and instead of the framework, which is becoming increasingly just a total exercise in financial surveillance of everybody, instead of that, I would direct more attention to proactive policing. And that might involve targeting people who are likely to commit crimes. It might involve intrusive surveillance. It might involve various other ways of reacting, which will not be popular. But I think in the long run, it would be, number one, probably cheaper, and number two, more effective.
Okay, thanks. I'm looking at the watch. I don't know how much time left you have, Peter, but I would suggest that we invest 3 more minutes. We could first deal with the question of Deborah, and then I would give a chance to Nikita to answer the question you asked earlier. So Deborah is asking, would having more effective asset recovery post-prosecution, I guess, be better? I don't know if Peter or Nikita, you would like to answer that.
They've tried recovery post-prosecution. They've tried recovery in the absence of prosecution. The problem is this: when the sea change in money laundering, anti-money laundering, proceeds of crime law took place, the promises for the amounts of money that were available made then were ludicrously inflated. And if you go back to the year 2000, the UK government was going to pay for the prison system out of the proceeds of crime, and it was going to pay for policing out of the proceeds of crime, and it was going to pay for this and that and the other thing, and none of these things ever happened. And instead of going for better asset recovery, maybe we should just lower expectations as to what kinds of amounts of money are available.
Thanks, Peter. So Nikita, on the past question of Peter, and then we will conclude.
Right, thank you. Yes, so regarding the behavior of the regulated sector, where, as Peter, you described first, the reaction is to object the change, which leads to administrative burden and costs. Whereas at a later stage, the industry participants tend to buy into it. They recruit people, adjust their organizational structures, and I think here is the answer, that once the organizational structure has been adjusted, there is less concern about the costs. They are internalized, and it becomes part of the operation, and also this allows to pass on the costs to consumers. Whereas perhaps what I would like to add here is that here first we are talking about large institutional players, whereas the situation is somehow different today with industry newcomers who largely employ way more, or try to challenge or enter the markets and gain market share by employing a more alternative business models which are supposed to be less efficient than those employed by the market incumbents. And here the game once again is or the question for them is, it's problematic. It's challenging the way the AML framework functions, because on the one hand, as I know for instance from the crowd lending industry, the market players who are in a way competing with market incumbents, with traditional banks, they would like to have a regulation which would clearly put them under the regulatory framework, under the AML framework. But on the other side, for many, the costs, the administrative burden that comes along with these requirements is way too high, and it affects their business models in a very significant way.
Thanks, Nikita. It's 2:08 here in Florence, at least. I would like to thank you both for your presentations and for answering the questions and fueling the debate. I think it's been really refreshing and insightful today. A bit more pessimistic than what I had in mind for Tuesday, but it's good to take a few steps back and look at how AML was decided to be constructed and why we're in this framework today. And indeed, there could have been other choices and other avenues, Peter. There will be more online seminars on other topics coming in over the next month, so stay tuned. In the meantime, let me wish you all a great day.